People say that success in trading is 20% skill and 80% psychology. I don't actually agree with that. I think it's different. I've seen that success in trading is mostly about the skill aspect. That being said, I've also found that well over 80% of the issues that people have with their trading are psychological. But these are symptoms, not problems. When you want to solve a problem, it's always best to look for the root cause. And in the case of trading psychology issues, the root cause is usually to do with the skill itself. If you focus on fixing the skill issue, the psychological problems just disappear. They're often a byproduct of not approaching the skill aspects correctly. So in this video, I want to cover the 4 most common or most challenging psychological barriers that I've come across. I'll also give you a solution or a prevention for each of them. But it's important to keep in mind that all of these issues can be complex. There could be many different causes, ways that they manifest, or solutions. But the solutions that I'll give you are the ones that fix them in most cases, or at least go most of the way to resolving them. Let's start with the most obvious one, and it's only obvious because it's so common. People struggle with taking a loss, and there are many reasons for this. So we all have a cognitive bias known as loss aversion. In short, this means that the pain of losing is twice as powerful psychologically as the pleasure of gaining. So we have a tendency to avoid losses more than we seek gains. But there is a caveat here. This is for situations where we see there being gains and losses. And this is where a lot of people go wrong with trading. People have become accustomed to viewing things as a matter of winning or losing. This applies to games, sports, business deals, and many other things that we can think of. It's all about winning or losing, and losing suggests failure. But trading isn't about winning or losing. In fact, it makes me cringe when people refer to their profitable trades as winning trades. And yes, I've said it in the past as well, but I make a conscious effort not to anymore. Successful trading is about having a long-term positive traders equation. It doesn't matter how many losing trades you have. What matters is that over time, your trading generates a positive output from this equation and is repeatable. Let me give you an analogy. Imagine we're going to be flipping a coin and you know the coin hasn't been tampered with, so there's a 50% chance of heads and a 50% chance of tails. And I say to you, if it lands on heads, you get $10. But if it lands on tails, you give me $5. And we can play this game continuously until you decide to stop. So in that scenario, how would you feel when the coin lands on tails and you have to give me $5? Would it bother you? You probably wouldn't mind at all. You know that each coin flip has a positive expectancy for you. So the more times we flip the coin, the more money you're likely to make overall. It doesn't feel like a loss when it lands on tails, it's just part of the process. Now, let me ask you another question. Do you know in that situation whether the next coin flip will be heads or tails? No, there's a 50% chance of each of them happening. You have no idea which one it will be. And the final question, would that fact bother you? No, because you don't care what the individual result of each coin flip will be. You want to keep flipping the coin because you have an edge. And this is the same with trading. We shouldn't be looking for so-called profitable trade opportunities. Instead, we should be looking for trades where we think it has a positive expectancy. This means when we assess the potential positive and negative outcomes and their probabilities, we have a favourable outcome overall. Let's say we're looking at a trading opportunity and there's a 60% chance of a loss and a 40% chance of a profit, but the potential profit is 50 pips and the loss would be 20 pips. Do we know what the outcome of that individual trade will be? No, we just know if we took that trade over and over again, or at least we think, 6 times out of 10 it would be a negative outcome and 4 times out of 10 it will be a positive one. But we don't know what the very next outcome of that individual trade will be. We're not fortune tellers. And it doesn't matter to us anyway. If it's a loss, who cares? As long as we keep taking trades with a positive expectancy like that, we just need to keep flipping the coin. So there are 2 main things to overcome this psychological barrier of not wanting to take losses. The first thing is to stop thinking of individual trades as winning or losing. Instead, reposition them as being part of a longer term process. And the second and more important thing is to start estimating the probabilities of your opportunities, the different outcomes that could occur. What are the probabilities of them? This way you can figure out what the expectancy of the opportunity is. And over time you can track the accuracy of your probability estimates, then go through a calibration process to improve them. And before we move on, just one more thing. You can only estimate the probabilities correctly if your trading method detects something meaningful in the markets, like a change in activity that lets you adjust your estimates of the probabilities. If it's just based on nothing, of course you're not going to have any edge. And whenever I talk about estimating probabilities, some people will complain that it's not possible. So firstly, studies have shown that it is possible to estimate the probabilities of future outcomes, and they also show that it's possible to improve your accuracy. And this is something that we walk our members through with great results. But if you don't consciously estimate probabilities, you're still doing it subconsciously whenever you make decisions anyway. And this applies to entering trades or assessing trade opportunities or anything else in life. We're going through probability estimates whether you realize it or not. When you trade, you estimate probabilities. So I encourage you to make it a conscious effort, because that way you can measure your accuracy and improve on it. And it may even reveal the reason why you're not succeeding with your trading as much as you'd like to. This next psychological barrier manifests in many different ways. Just a quick one before we continue. If you want more important insights to improve your trading performance, check out the link in the description box to my 1-hour training. I explain things that other trading lessons never cover, and these are really critical for succeeding over the long term with your trading career. So, some of the more common ways are hesitating to open trades, reducing your capital or getting nervous after hitting a string of losses, and closing trades too soon. These and many other problems relate either directly or indirectly to doubt, and more specifically, self-doubt. So let's go back to that coin flip example from the previous point. If we were playing that game and you hit tails 10 times in a row, so you kept losing money, kept paying me that $5, but you knew the coin was fair, would you have any doubts about flipping the coin again? No. You know a losing streak will happen based on probabilities, but the expected value of each coin flip hasn't changed. You still have the edge, so you keep playing, you keep flipping the coin. Most of the self-doubt that you experience as a trader simply comes down to not knowing your trading numbers. You may think you know your numbers, but then you hit some losses, a losing streak, or have a period of uncertainty, and it makes you question everything you knew about your trading. And that's because most people who think they know their numbers haven't gathered them correctly or with a big enough sample size. And I spoke about this in a previous video, which I'll link up here, and I explained what an appropriate sample size should be. And there are two things you can do to fix this. Once again, the first thing is to focus on taking trading opportunities with a positive expectancy, rather than trying to decide if an opportunity will be profitable or unprofitable. Now, there's another video I'll link up here where I explained how this completely changes the way that your brain processes the situation. It turns it from an uncertainty to a risk, and that means less reliance on emotion, and particularly fear, so you process it in a completely different way. The second thing is to invest your time into collecting a big enough sample size to be able to really rely on your trading numbers. And don't just focus on whether you're profitable over a large sample size. Also focus on things like the accuracy of your probability estimates and whether the opportunities you're taking genuinely do seem to have a positive expectancy. And with both of those points, they're only going to be dependable and meaningful if you have a consistent approach that you use for your trading. Otherwise, each trade is completely unrelated and your data as a whole isn't going to give you any confidence. Like if every trade is approached in a completely different way and you're only profitable overall because you have a few lucky home runs, of course you're going to have some doubts about your performance. Instead, if you approach your trading in a consistent way and you have positive numbers from an appropriate sample size, this removes the self-doubt almost completely. Of course, some people have self-doubt in general due to low self-esteem, perhaps from past traumas, but this is the psychological part then that needs to be solved and isn't related to the skill aspect. But for most people, it's the skill aspect, and the points that I've provided should prevent or solve this for you. Everyone always focuses on how difficult it is to deal with losses. Most trading psychology videos or lessons are about the losing side. But I've been involved in the markets for over 20 years and I've taken some huge losses, even six-figure losses at some points, and I can tell you from my experience and from what I've seen from other successful traders, the most psychologically difficult part has been dealing with profits. In fact, here's a clip from the legendary trader Andy Krieger saying pretty much the same thing.
Now what happens? Dollar yen now crashes off to 130 and my options are now worth 2%. I made 20 times my money. What do I do? That's the hard part of money management, because when a position goes against you, if I have a spot position, it goes against me, I have a stop loss, it's easy, I'm out. But managing profits is hard because you have to manage your psychology, you have to manage your expectations, you have all this ego stuff that starts to bubble up. I've seen many traders. I've hired many, many, many traders over the years, and some of them couldn't deal with profits above a certain level.
This leads to people closing profitable trades way too soon or way too late. Like I explained in this video up here, most traders end up feeling frustrated with almost every trade because they measure themselves against the perfect exit, and this then creates lose-lose situations for them. But there is some good news for you. As you get more experienced and profitable trades aren't such a surprise for you anymore, they do become easier to deal with. But as I said, focusing on the skill aspects can solve most trading psychology issues, and this is no different. So how can we solve this issue through improving our trading skills? Now, I'm going to sound like a broken record, but it's all about the expectancy of the opportunity. And you'll notice this come up time and time again. I stress it so often because I hardly ever see traders talking about probabilities. But it's only by estimating probabilities that you have any idea at all whether your decisions are the right ones to take. This is the key skill that traders need to develop. So think about your trading. How are you currently deciding when to exit a profitable trade? Is it when it hits your target? Is it when it struggles at a key level of some sort? Is it when you've made a certain amount of money? Or maybe it's just based on a gut feeling or something like that. I believe it should be by analysing the potential next outcomes and assessing the expectancy of the situation from that point onwards, just like I think you should do with your trade entries. So this means that you should continue to actively analyse the markets after entering a trade to anticipate and assess the next potential price movements. Then the changes in expectancy will dictate whether it's no longer viable to keep the trade open, or when the expectancy's dropped enough that it's still viable to keep it open, but maybe time to take a partial close and scale out of the trade. Or in some situations, it might even be that the situation's improved and it's time to scale into the trade. You know, here's something that I think is really important. I advise you to stop thinking of trading as being completely different to anything else, to any other fields. Instead, look for similarities with other fields. Think about the way that experts or the really top performers in other fields would make decisions and what role their analysis would play in that process. It should be focused on the expected value. This takes the guesswork and the psychological aspects out of this decision to exit a trade or not. There are two broad areas where we see this psychological barrier. The first is with your development as a trader, and the second is with your individual trades. So let's start with your development. Many traders are short-term focused with their progress. They want to be profitable with their trading yesterday, and they're not willing to wait to achieve their goals. So as a result, they try to fast-track themselves to live trading, and then they beat themselves up when they're not achieving the profits that they expected. And there are many causes for this, but two big ones are unrealistic expectations and a lack of clarity over your development process. The unrealistic expectations are unfortunately a byproduct of the culture online, particularly on YouTube and social media. If many flashy trading gurus are promoting how quickly and easily they became profitable and rich, that's going to impact your own perceptions about your progress. Likewise, if these people are constantly talking about monthly double or even triple digit percentage returns, you'll feel like an underachiever until you reach that. And that's not really something realistic to achieve on a regular basis. If it was, all those people would be billionaires. So you need to look at trading as a profession. As simple as people make it sound, it's actually a complex skill, and there are many individual skills that you need to develop to succeed at it. So just like any other difficult profession, it takes time to learn. You wouldn't expect to start a degree in engineering and be in a top-level job earning megabucks after 6 months from starting. It's no different from trading. It takes time of dedicating yourself to learning the skill before you start earning good money from it. Many people think that rushing your way to profit in the live markets will help you reach your goals faster, but it's actually more likely to slow you down or even reverse your progress. In fact, most of the members that we have at Duomo are people who started off learning elsewhere, and they'll often say how they've wasted so much time chasing this instant success that other people were promoting, wasting months or years going through funding challenge after funding challenge, only to realise that actually they needed to develop their skill further first, and that time could have been spent on that instead. And this does actually relate to the second point, which is having no clarity over your development process. So traders are often working forwards towards their goal of becoming profitable. Essentially, they learn the basic skill and then think, okay, what's next? And then what's next and what's next? Kind of like trying to find your way through the woods without anything to guide you. It's like, okay, do I turn left or right here? Now what? Left or right? Instead, it's a much better idea to start from the end and work backwards, to think about what you're trying to get to and what skills you'll need to be consistently profitable or whatever else, and then think one step backwards from there. What would be the final thing you're working on before becoming consistently profitable? How long would that take given the time that you have available to work on your trading? Then what about one step back from there? And so on and so on. Essentially, you want to figure out the major milestone goals that you need to achieve en route to being profitable with your trading. Then figure out the stepping stone goals that you need to work on a daily basis to achieve each of those milestones. And this will give you much more clarity over exactly what you need to do and how long it may take. Then you just focus relentlessly on the next milestone goal and the individual actions that you need to take to get there. And don't get distracted by the end goal, just one milestone at a time. Listen, I think it's great to have a sense of urgency with your development or your work in general. It's something I try to encourage my team to have, this feeling of urgency. But this should manifest with you taking the right actions each day with intensity. It shouldn't be causing you to look for shortcuts or trying to rush your progress. This ends up happening when you feel like you're falling behind some arbitrary deadline or goal that doesn't really need to be there. Now, I first started learning about the markets in 2002, firstly focused on investing and later on trading, and I went full time with my trading in 2012. That's 10 years later. I'm not sure exactly at what point I would have been considered consistently profitable. It's not like you wake up one day and suddenly you realize you've done it. But I can tell you for sure it wasn't anything less than 6 or 7 years after I'd started. Now, I'm not saying it will take you that long. Hopefully it won't. I was young and naive. I made tons of mistakes doing things the hard way, but hopefully that gives you more perspective. I can tell from our analytics on YouTube that the largest part of our audience is male below the age of 25. And those are the years as a man where you feel like everything needs to happen instantly. But as you get a bit older, as you hit your 30s and so on, you begin to realize that things just take time. And if you focus on doing things the right way, regardless of how long they take, you're actually more likely to reach your goal in a more efficient way. I always think of it like running a marathon. So imagine you want to improve your marathon time. What would be the right strategy to take? Would it be to try and sprint right from the start? Of course not. But that's how a lot of people are approaching their trading development. Instead, the better way is to think about the entire journey and work backwards from there. Find where there could be efficiencies or improvements that could speed things up. Essentially, you want to work on finding the pace that ensures you do reach the finish line. That's the first priority. And then figure out how to go faster without compromising that. So when it comes to trading, it should be focused on actually reaching the goal and then start thinking about where you can make things more efficient rather than sprinting your way there and burning out or not reaching it at all. And then we come on to the next part of short-term focus, which is about the individual trades. Now, as I've mentioned earlier in this video, too many traders feel like their performance lives and dies on each individual trade. They take extreme measures to try and make sure each trade is a profit. They hold on to losing trades too long, they move their stop loss, and they take their profits too early. And ultimately, these actions may increase the chance of that individual trade being a profit, but that comes at a cost. These actions may actually be negatively affecting your long-term trader's equation. So although you get that dopamine hit from an individual profit, your long-term performance is likely to be negative as a result of that. Instead, you should be entering and managing trades while keeping your long-term performance in mind, thinking about how the actions you're taking will impact your trader's equation overall. If you deviate from your plan on an individual trade, what will that mean if the same situation played out 100 times? How are your actions affecting the probabilities or the potential future profit and loss? That, I believe, is the key to successful trading. Executing each individual trade in the most optimal way, but in line with what will lead to good long-term performance. And in some cases, that means taking a loss on an individual trade rather than taking actions that expose you to more risk. You know, people get instant gratification from the outcomes of individual trades, but you need to find a way to condition yourself so that the instant gratification is attached to taking actions that benefit your long-term trader's equation. So hopefully you can see the recurring themes in the things that I'm explaining to you. I don't care about short-term success. I care about sustainable, long-term, lasting success. And you should as well. The right way to go is focusing on things like probabilities and the trader's equation and following plans that increase the probability of succeeding over the long term rather than just the ones that will maybe get you there quicker. I know some of you, or most of you, will disregard all of what I'm saying. Some people hate it when I'm realistic and conservative because it feels like I'm dampening your hopes and dreams. You know, I'm not here to teach you how to gamble, but people want the racy, flashy, exciting stuff. I'm here to help you succeed. And hopefully if just one of you takes on board the things that I'm saying from over 20 years in the trenches, then I'll be happy with this video. So if you made it this far, I think you also deserve to know the truth about emotions in trading. When you look at the science behind it, you realize that most trading psychology advice is completely wrong. So you can find out the truth in this video here.